Introduction of a concept map. Okay, I just uploaded this PDF file this morning. Don't worry about it. It's very simple. You can download it later. The idea is simply the following. The slides are built on the book. Basically, they follow the book. And the book is very detailed and sometimes gets lost a little bit down the rabbit hole of some technical aspect. Okay? And so what happened is that my feeling is that people may lose a little bit the thread of the big picture, what's going on. And so what I did is just to upload one page, it's just one page PDF that you have now online, with a concept map. I'll try to do this for most lectures where there is some complexity that needs to be taken care of, with just the main ideas. And I'm going to spend a couple of minutes at the beginning just to give you the big picture. Then we go through the slides into the detail. So the idea of today is to start with the concept of valuation, and specifically valuation based on comparables. Okay, now I'm trying to find out. When you value a company, and remember, for us, valuation is a tool. Our job as investment bankers is to advise our clients on strategic acquisitions, for example. And if I tell my client, hey, look, you should buy that company, or my client comes to me and says, I would like to buy that company, we need to tell them, well, look, according to our calculation, you should pay this price. So we need valuation. Or we may be the advisor of the seller in a sell-side deal. What happens? Either the CEO of a company says, okay, I would like to sell my company to somebody else, or we receive an acquisition proposal from a third party. Somebody knocks on our door and says, I would like to buy your company. And so again, the investment bank steps in and says, well, look, if you want to sell, you should ask for this price because this is the value of your company. So these are this type of situations where an investment banker is asked to produce a value for a company. And there are two big philosophies when you need to find the value of a company. The first one is to say, okay, let's look at how much, for example, earnings or cash flows the company will produce in the next future. Okay? And the valuation of the company, the value of the company, is the present value of the future cash flow. And this is what we are going to do in 2 weeks, the so-called DCF, or discounted cash flow, that you have already seen. You may have done in corporate finance something a little bit more simplified that is called the dividend discount model, roughly the same thing. The value of a company is the discounted value of all the, let's say, cash flows or dividend produced in the future. And that's one possibility. You will see in 2 weeks that's a very complicated technique. So one possibility is to do something slightly simpler. That is, let's look at similar companies or comparable companies. And let's see how much they are worth. And then we can, in a sense, translate that valuation to our company. So we are going to base the value of our company on the value of similar companies, what we call comparable companies. So the first thing that we're going to do is going to be basically to define what is a comparable company. And we will say something like, look, a comparable company is company that operates in the same industry, for example, a company that has the same business model, maybe a company in the same country of similar size, similar historical track record. So these are all aspects of similarity, and you will see when you will do your assignment, you don't have perfect comparables. And so sometimes you need to accept a company that has a similar business model but operates in a different country, or that is in the same industry but has a slightly different business model, or that has the same business model in the same country but is much bigger or much smaller, so of a different size. Okay? So you will need to adjust and improvise. Sometimes One of the stories of the week that we don't use anymore because now it's 6 years old, but it used to be quite interesting, was somebody trying to apply this valuation technique to Amazon, and basically failing because Amazon is so unique that you cannot find anything that is slightly comparable. Okay? One slight variation of this methodology is based on, instead of comparable companies, comparable transactions. So the idea is I am a company. I have received an offer from another company who wants to buy me. Okay? And they are offering a certain amount of money. I want to know whether this price is correct. Well, what the investment bank will do, maybe instead of looking at comparable companies, we look at comparable or precedent transactions. What does it mean? It means other acquisitions of similar companies that happened in the last 5 to 10 years. And they say, look, 3 years ago, that company was bought for this value, for this price. Well, we can use that information to find the correct price for our company. Okay? And again, we will spend some time in defining what is a comparable transaction. It's usually a transaction, an acquisition, where the target company was similar to us, was comparable, and then has some similarity, like, was a majority or minority acquisitions, the same type of buyer, similar payment method, cash versus equity, similar level of hostility, etc. All these things we will go back. Okay, so I'm just giving you the map. So our first port of call would be to define, okay, what is a comparable? Either a comparable company or a comparable transaction. Once we have the list of the comparables, for example, for your assignment, you will have to find 10 comparable companies. When you have a list of your comparables, then you need to measure the valuation multiples for the comparables. Okay? And the idea is that you don't really care about how many $1 million a comparable is worth. Because that, a comparable could be a bigger company or a smaller company. So the number is worth $10 million doesn't tell me anything. What I really want is a so-called valuation multiple that has at the numerator sales, EBITDA, EBIT, or net income, so a measure of profits, and at the denominator either equity value or enterprise, so the value of the stocks or the value of the enterprise. Okay? And again, I'm going to show you later how this works. But the idea is we are going to calculate the value of the comparables. So step 1, find the comparables. Step 2, calculate the value of the comparables in some way. And then we are going to apply all this information to the valuation process. And the valuation process is very simple. Find the comparables, calculate the ratios for the comparable, take the average ratio, apply the average ratio to the target company. Let me give you one example. The whole rest of the lecture will be simply based on going through these concepts and see the different bits and pieces. Okay? On some slides, I will skip because they are trivially boring, but again, they kind of follow the outline of the book. Okay, so this is a very, I apologize for how stupid it looks, but let's assume that I have 3 comparables, A, B, C. And for every comparable, I look at the net income per share, the so-called earning per share, and then I look at the price of the stock. Okay? And let's assume comparable A has an earning per share of $1 and a price of the stock of 10. comparable B has an earning per share of 2 and a price of a stock of 30. Comparable 3 has a price of the earning per share of 2 and a price of the stock 5. Sorry, 10. Okay? Is the concept of earning per share clear to everybody? Please stop me because most of these things you should already know them from basic corporate finance, but sometimes there is a terminology that is a bit different. So earning per share is just the total income, the net income of the company divided by the number of shares. So is how much earnings go to every stock. Okay? So what I can do is to calculate the price-earning ratio. This is my valuation multiple for the 3 stocks. Okay? Let me write a little bit higher. Price earning. Okay? So the price earning here for stock A, how much is it? How much is the price earning ratio? 10. Okay? Actually, we usually say 10x. Means 10 times. Means the price is 10 times the earning. How much is for company B? 15x. How much is for company C? 5x. Okay? So basically we are saying, look, company A is trading at 10 times the earning per share. That is what you would hear in the press. Company B is trading at 15 times earning per share. Company C is trading at 5 times earning per share. Okay? Now, let's assume that A, these are really good comparables, and B, we don't have 3, but we have 10 of them. Okay? Then we calculate the average. And here the average, just to make things simple, is 10, 10x. And so we say, look, similar companies, on average, have a valuation multiple of 10 if for valuation multiple we take the price earning. And by the way, I just realized that probably in the concept map I mixed up numerator and denominator. I will fix it. But the multiple in this case is the price earning. So the price earning is 10x. Now, how does this help me in finding the value of my company? Well, it's very simple. At this point, I will simply look at my company, and I will say, look, what is the earning per share of my company? The earning per share of my company is $3. Okay? So what is the correct value of my company? What is the correct stock price for my company? How much is my company worth? If similar companies on average trade at 10 times earning per share, and my earning per share is 3, how much is my company worth? $30. So, in theory, the correct price or the target price or whatever you want to call it of my company is $30. Okay? Now, this is a super simplified example, but as you can see, the basic idea is find some comparables, calculate the valuation ratio of the comparable, and repeat, the valuation ratio is always the ratio between the value either of the equity capital, like in this case, the value of the stock, or a little bit more complicated, later we will see the enterprise value, that is a different concept, but basically is a measure of value, divided by some sort of measure of income. In this case, we are using net income, earning per share. Okay? And so you see the average ratio, and then you say, well, look, I can apply this multiple to my company. Okay? So this is the valuation on comparables. So as you can see, it's incredibly simple. There is absolutely nothing conceptually complicated here. The whole problem, the whole story is just a matter of finding the right comparables, choosing the best valuation ratios, and then do the calculation. Okay, so the whole rest of the okay, so good morning, everybody. Today we start the first real lecture. I'm recording the lecture. I'm trying different solutions of recording techniques. So this, where I can plug in my mic, optimizes the audio, doesn't optimizes the video. You get the bar on the left is a bit annoying. I apologize for that. I will try something different next week. But anyway, so today we start the first big chunk of topics, that is valuation. By the way, as a organizational issue, sometimes the lecture is not in the morning, like in the afternoon, and so the tutorials are, some of them before the lecture, some of them after the lectures. To avoid any kinds of alignment problems, tutorials are always delayed by 1 week. Okay, so the tutorial related to this content will be next week, and today's tutorials will be related to last week's content, so the general introduction to the subject, etc. This is just to, because sometimes some people have the tutorial before the class. So the idea is we are going to see now valuation based on comparables, and next week during the tutorial we will do an exercise on this. Okay, so that's the idea. I made a change compared to what we did last year, and this simply, okay, so this is the original set of slides that you have. I think we've done the introduction. Just one thing, this book uses a different types of steps, some of them with weird names, but basically select the comparables. That's step 1. Step 2 is kind of trivial, is find the information. Okay, we have FAQST, we can find the information. Step 3 will be to calculate the valuations for the comparables. Step 4 is a bit weird. We are going to introduce, is not really relevant. It just means try to assess if your comparables are of different quality. Maybe some of them are really better comparable than others. You may want to treat them differently, but it's just a little bit of a technicality. And step 5 is just to do the calculation. Okay. We have, do I have it here? Yeah, okay. Already explained this. Now, when it comparable comes to, let me give you, this is an example of the spreadsheet that the book has and that you have in UTS Online. These are the valuation models of the book. Now, be advised that every bank uses slightly different models. So this is going to be a source of frustration that will go through the whole subject, so just deal with it and get ready. So what's going to happen is the following. Every bank has their own Excel models. Okay? They are all slightly different. They are all pretty similar and slightly different. Okay? If you look online and you download, you Google comparable companies analysis or CCA valuation models Excel, you will download maybe 2 or 3 different spreadsheets. They are all slightly different, so don't get stressed. It's just that more or less everybody does something different. But at the end, you will get to something like this. So this is the final output that you find in the book and in the evaluation models provided. So what we have here? Here we are trying to find the value of this company. And then we have around 15 comparables. And first of all, one thing that the book suggests is that you want many comparables, lots of comparables, but not all of them are as similar or as really comparable. In this case, what the book suggests is you should tier your comparable. You should divide them in group. And keep in mind which one are the best ones. You know, in this case, what the example does is to divide them by business model or industry. So tier 1 are specialty chemicals. Tier 2 are diversified chemicals. And tier 3 are small cap chemicals. Now you can imagine, my guess, if I understand the tiering correctly, is that tier 1 are the best ones, because probably my target is in the industry so-called specialty chemicals. Don't ask me what they do, but they will do weird stuff with chemicals. Okay. Now maybe there are only few companies in that industry. Maybe only 5 reasonably of good quality. They say, okay, 5 is not enough. I need more comparables. Well, let's take other companies that are, kind of in the same ballpark, like diversified chemical. It's not exactly the same business model, but they can still be useful as a valuation tool. And then maybe let's get a third group. And third group are small cap chemicals. And probably these are, third groups of companies that are of a much different size than mine. So again, they can provide a bit of information, but maybe not as much. Okay? Then it gives you some information, the share price, the equity value. Equity value is just the share price multiplied by the number of shares, and the enterprise value that we will see in a second. And then it gives you the multiples. As you can see, there is a first batch of multiples where you have enterprise value divided by, and then it could be divided by sales, EBITDA, or EBIT. And we're going to see later what they are. But sales is sales, EBIT is earning before interest and taxes, EBITDA is earning before interest, taxes, depreciation, and amortization. Should familiar with the term, but we're going to go through them. And then you have the multiples. So for example, on average, companies are trading at 1.5 times sales, or 7.7 times EBITDA, or 9.8 times EBIT. One other thing that you will see is that for every multiple, there are 3 versions. There is LTM, 2012E, 2013E. What does it mean? LTM is a multiple based on historical values. So, for example, LTM, enterprise value to EBITDA to sales, means I'm using the sales LTM of the last 12 months. Okay, so LTM means last 12 months. Again, we're going to go through this. Now, technically, you don't really care about the past. The past is past. Okay? If you buy a company, you don't care how profitable it was in the past. You care how profitable it's going to be in the future. And so, sometimes the past is useful because it's a guidance for the future. But maybe you can find information on the expected value of sales. For example, 2012 and 2013. I assume that this example was based in 2011. Okay, so I say, okay, so next year and 2 years from now. And so you can look at the multiples using not the historical sales, but the expected sales. Okay? Okay, so different multiples in the sense enterprise value divided by different stuff. Then we have the second bunch of multiples that are instead based on price earning. Okay, so this is a second group of multiples. Again, enterprise value based, equity based. We are going to see this later. Okay, and then of course, for every multiple, you calculate the mean and the median for every tier, and then here below you have the mean and the median for the complete 15-group sample. You also have high-low. We will see how you can use all these pieces of information. Usually what you really care about is either the mean or the median. Okay, but we will see later. Okay, so this is just an example. Now, we keep talking about comparable companies, but if you remember the concept map, we also said, well, look, sometimes instead of looking at similar companies, we look at similar acquisitions. That basically is acquisitions of similar companies. Why is that? The basic idea is very simple but very important. When you buy a company, with the idea that you're going to merge with this company, the value that you're willing to pay is usually more than the value of the company standalone. Okay? Now, let me give you an example. There is a company out there that is trading at $10 per share. Okay? Technically, this whole valuation exercise is kind of useless, because what is the value of that company? $10 per share is how much it's trading on the market. That's it. Okay? Why? I mean, I apologize, I'm taking some things for granted. This is if you espouse the Chicago view, that the market is always right, what is called normally the Chicago view. So the market uses all the available information. So if the stock is trading at 10, the company is worth 10. When you go and try to buy that company, okay, by definition, you cannot offer less than 10, because nobody will sell you the stocks. You know, say, okay, you're stupid. Okay, if on the market the price is 10, and you guys say, okay, I'm going to buy your stocks for $5, they will tell me, okay, thanks. Nobody's going to sell. But many times, I'm willing to pay more. I'm willing to pay $11, $12 per share, even if the market price today is 10. Why is that? Because I think that the value of that company, when it merges with me, is actually more than 10. Anybody can give me some example of why? If I buy a company with the idea of merging with that company, I'm willing to pay more than the current market price. I may be willing to pay more than the current market price. Any idea? Okay, so get used. I'm going to ask questions, okay? It's not marked. It's not assessed. Nobody cares anyway. So just, yeah?
The company sort of did something, like I don't know, installed security cameras, and they bought out like another company, like an electrical company, they could sort of combine their customers together.
Okay, he says, well, maybe we can cross-sell. I can sell my product to their customer. They can sell their product to my customers. How is this called technically, in accounting jargon or in finance jargon? This is a revenue synergy. Okay? It means that when we merge, the revenues of the combined company is going to be higher than the sum of their revenues and my revenues. Why? Because, for example, we do cross-selling. They have a lot of clients, and they are selling dishwashers. I have a lot of loyal clients, and I'm selling refrigerators. Look, we can sell, to the other client as well. For me, the most striking example of revenue synergy is when Google bought YouTube. You don't remember when YouTube was an independent company. But when YouTube was an independent company, they had a lot of content, well, much less than today. They had content, but they had a lot of problem in finding advertising. Google came along and said, look, you have content. I have the most powerful advertising machine in the known universe. This is a match made in heaven. I'm going to buy YouTube and put my own advertising in the YouTube videos. You know, so that is a revenue synergy. Other reasons? Yeah.
This would be a cost synergy is when like your back office IT system and things.
Cost synergy. That basically means we are going to fire some people. Okay. I don't need 2 IT departments or 2 HR departments. Well, firing HR is always difficult because they are the ones who do the firing, but you get the idea. Okay? So the fact that you have synergies means that comparable companies analysis always give you a price that is a bit low because you're looking at the other companies out there standalone. More interesting is to look at other instances where there was an acquisition and a company similar to myself bought a company similar to my target. How much were they willing to pay? Because that price, that valuation multiple of that acquisition will give you, because in that acquisition price there are synergies included. Because it was a real acquisition, so they were paying out some of the synergies. The valuation was reflecting possible synergies. Okay? So that's the idea. So why we want comparable transaction analysis? Because they are better to account for synergies and for the so-called control premium. Control premium is a little bit more technical. The idea is, if I look at comparable companies around standalone, basically what I get is how worth is one stock of those companies. I get their price, basically. But if I buy a majority stake or a control stake in a company, usually you pay a premium. The idea is, generally speaking, in the market, if you buy one stock in a company, you pay $10. If you buy 51%, usually you pay more than $10 per share. Why is that? Why is that? Yeah? Because you buy the power of doing whatever you want with that company. So the control has value because you can change the company, you can name yourself CEO, you can do a lot of good stuff, a lot of stuff that you like to do. And so that's worth something. Okay, so this is why we want to look at similar transactions. Naming convention. I personally like the similarity of called comparable companies analysis, comparable transaction analysis, CCA, CTA, but the book and part of the financial industry, instead of talking of comparable transaction, they talk about precedent transaction. Okay, so just a bit of terminology. Okay, so how do you find the comparable companies? Well, the first step is, first of all, you want to understand your target. Okay, you want to understand exactly what the company that you want to buy does. And basically, this means understanding their business model. Okay, now forget about if your company is publicly listed, it's very easy to find information. If it's private, it's a pain in the neck. But basically, the first step is you need to pin down exactly what your company does. And then, ideally, you want to find companies that are similar across a whole bunch of groups of characteristics. Because what you're really looking for, and weirdly enough, this is never written in the book, it drives me nuts, but usually what you really want is comparable growth opportunities. This is what you really want. You want to find companies that will very likely behave in a similar way in the future. And this means They should be in the same sector with the same business model, same type of product and services, same types of customers, same types of distribution channels and geographical background or breakdown, similar profitability, similar size. Ideally, you want an exact replica of the company. You will never find it, and so you need to make some choices. Okay, and then, as we said, usually you want to divide them in tiers. So you can actually look at, okay, look, this is a smaller sample, but of very similar companies. What information I get from here? This is a bigger sample of slightly less similar companies, etc. Okay, so that's the idea. I love that the book points out that it's an art, not a science. And again, this drives people absolutely nuts during the assignment, because even if you're not supposed to, you're going to talk to colleagues from the other groups, and you will find that the overlap between your 10 comparables and their 10 comparables is basically non-existent. It says, is one of the two groups doomed to fail the assignment? Most likely not. Maybe you are just, two slightly different preferences, or whether you should prioritize a similar business model or a similar geographical area or a similar size, whatever. Okay, I'm going to skip on this. Locate information. I'm going to skip it simply because in the practice of the industry, this is no longer an issue, because now you have these organized multi-source data providers like FactSet that give you basically most of what you need and give you the link. You will see, if you start looking at FactSet, the very interesting thing is that almost every number, most numbers that you find, most pieces of information are hyperlinks. And if you click, it will open a financial statement for 2015, or these company announcements, or this other thing. Basically, it gives you where the numbers come from, the original source of documents, etc. So they are very, very powerful. Okay, so now we need to start calculating the valuation ratios. Okay, so what's going to follow now is a series of slides, or if you go through the book, a series of pages on the book, where there is just a little bit of a long and not super well organized laundry list of financial names, financial pieces of information, etc. You should be familiar with most of this stuff. For the more complicated stuff, we have a next week lecture where we're going to through some technical aspects. But generally speaking, you should be familiar with most of it. Okay, this is the Excel. This is just to give you an idea. You will get to know this Excel spreadsheet and deeply, deeply hate it. Basically, this is where you are supposed to take information from FactSet or any other source of information and paste it or plug it here. So for example, a general convention in the Excel spreadsheet of the book is that the yellow stuff is the one that you have to change, the blue stuff you don't have to change. So the yellow cells here is basically you're going to put 3 years of historical income statements from all your comparables. So that's what you need to start looking at. And then the Excel spreadsheet will do all the calculations for you. Okay? So it's a bit annoying because there is a lot of cut and paste. And also it's quite annoying because sometimes the way they put down the income statement doesn't really match the way that you get the data from either FactSet or Morningstar or Bloomberg or whatever you're using. And so sometimes you can't really simply cut and paste the whole thing. You need to cut and paste line by line. But we will learn to survive. Forget for a second what is a stub. I'll get back to that in a second. Okay? Okay. Anyway, we will go in great detail through this spreadsheet next week in the tutorial. So for now, just the important thing is to remember that you're supposed to take information from financial statement or FactSet or wherever and plug it here. Okay, so this is the type of information that you are supposed to know what it is. Okay, these are roughly a laundry list of the accounting terminology that working in investment banking requires you to know. So you need to know what is an equity value, what is an enterprise value, and then sales, gross profit, EBIT, EBITDA, net income, and then the different types of return of investment, return on investment capital, return on equity, return on asset, dividend yield, leverage, coverage, etc. So let's go through them. So now we have basically the market value. I deeply apologize if this is incredibly boring and well known. Let me go through it once, then we can move to more interesting stuff. Okay? So the first thing is equity value. When I look at a company as a comparable company, the first thing that I need to know is how big is the value of the equity capital of that company. Remember that when we did the valuation ratios, we look at price over earning per share. Sometimes, for a reason that will become clear in a second, instead of looking at price of one stock and earning per share of one stock, you want to look at the value of all the stocks, called equity value, divided by the earning per share of all the stocks, that is the net income. Okay, so it's just, and so the equity value is very simply the share price multiplied by the number of shares. The problem is that the number of shares that a company has is not very clearly determined. You say, how is that? Isn't it public available information? How much share exists? Yes, you can open every source of data from Yahoo Finance, Google Finance. They all will tell you how many shares a company has. But usually what you get is what here is called shares outstanding. So the number of shares that are out, that are issued by the company. But the problem is the company can have issued either options. Remember that an option is a security that gives you the right to buy a share. The company can have issued stock options, for example, to CEOs and CEOs and key employees and other people. So there can be options that can be converted in shares, so they are potential shares. And then you also have convertible bonds. Convertible bond is a bond, so is a debt security that can be converted into stocks. And so usually in valuation, when we look at ratios, we can not only look at the number of shares outstanding, we also have to look at all the possible shares that can be that will likely be created during the next 12 months, for example. And so we need to do basic shares outstanding plus the other stuff. Okay? So, original. Let's see an example. Let's focus on the options now. Okay. So, let's assume that a company has, here all the numbers are in millions, okay? A company has 100 millions of shares outstanding. Okay. Then the company also has 5 millions of options. Okay? Now, the 5 millions of options are potentially 5 million of additional shares existing. Okay? Now, if you remember, an option will not be converted all of the time. When is an option exercised? So when an option actually becomes a share? Do you remember? Yeah? When it's convenient, that technically is in the money. Okay? If you look at this example, says the current share price is $20. The exercise price of the options is 18. So basically means the holder of the option can convert the option into a share for a price of 18. Or more correctly, the holder of the option can exercise the option and receive a stock for a price of 18. Now, will this guy do it? Will this person exercise the option? Well, if the person is rational, yes, he will. Because he can buy a stock for 18, but the current value is 20, so it's convenient to exercise the option. Okay? Now, if the exercise price was 25, so the option is out of the money, we just throw it away, we don't care, because it will not be exercised. Okay? But in this case, is in the money, so we assume that it will be exercised. Okay? So, what happens? Well, can we simply say, look, in this case, the company has 105 million of shares? Well, not exactly. That would be simple. Say, okay, these 5 million of options will be exercised, so the company will have 105 million of shares. Not exactly. That doesn't work like that. Because when we exercise the option, we need to pay the 18. Okay? And so, what's going to happen? The following is going to happen. Let's assume that there is one guy who has all the shares, all the options, so it's simpler. The guy will exercise the option and will get 5 million of new shares. So 5 million of new shares are created. But the company will receive $90 million because it's 5 million times 18. Okay, so the company will receive $90 million. So the way the methodology, this is called the treasure stock method. This methodology makes the assumption that these $90 million of cash are used to buy back some of the shares. Okay? So $90 million, the current share price is 20, so I can buy back 4.5 million of shares. So 5 million of new shares are created when the option is exercised. 4.5 million are bought back with the proceeds of the exercise of the option. So the net new number of shares created is 0.5 million. And so the so-called fully diluted shares outstanding is 100.5 million. Okay? Now, please be advised that nothing of this actually happens. Okay? This is just a theoretical mechanism for when we do the valuation of the company, we understand what is the real amount of money that there is in the company. Because yes, there are 100 million of shares, and that's on the books, but then I have the stock options that will be exercised, very likely. And so the way I think about the company at the end of the year is, okay, at the end of the year, there will be a company that has a little bit more shares. There is an alternative methodology that the book doesn't do because nobody uses it, that is just to say, well, look, the number of shares goes to 105 million, and we put the 90 million in cash. But that creates a complication in the whole valuation, because then your cash balance is no longer the real one. It's complicated. So the standard is just to say, look, now it's very important that we understand what is the FDSO, fully diluted shares outstanding. The good thing is that FactSet gives us this number already, so we don't have to calculate it. Okay? But it's very important to understand what it is. Okay, go back to our market value of the. Now, sometimes we base our valuation on the equity value. Okay? Sometimes we base the valuation on the equity value. Some other times, instead of finding the value of the equity capital, we want to find the value of the whole company, including both equity and debt. And the idea is the equity capital goes to the shareholders, the debt goes to the debt holder. Together they own the company. They own the assets of the company. The reason why sometimes instead of looking at equity value we want to look at the enterprise value is because equity value can change a lot given the debt structure of the company, while enterprise value doesn't change. Basically, enterprise value is going to be the same regardless of how much equity, how much debt you have, because it's basically measuring the value of the assets of the company and not the value of the equity. Okay, so what is the enterprise value? The enterprise value is basically equity plus debt. Equity plus debt. If you remember this, that enterprise value you're good. Okay? Now, we need to do some refinement. First of all, a company like Apple, does Apple really have debt? I'm sure that Apple has debt, but Apple also has 230 billion of cash. Okay? So the idea that if you have $100 million of debt, but then you have $50 million of cash, or sorry, let's say you have $100 million of debt, but then you have $30 million of cash, how much is your real debt? Because you could use that cash to pay off the debt immediately. So when we look at the enterprise value, actually, instead of looking at debt, we look at net debt. And net debt is basically debt minus cash. Okay? So, equity plus debt minus cash. This is really your equity plus debt minus cash. Now, there are still a couple of complications. One complication is that the company may have issued some preferred stocks, and preferred stocks are stocks without voting rights, and they usually are not included in the equity value, so you just need to put them back. And then the company can have minority interest in other companies, and they also should be put in. Okay? But basically, apart from these two things that are kind of not very common, the most important thing is to remember that the enterprise value is the value of the whole company, both the portion that belongs to the shareholders and the company that belongs to the debt holders, to the creditors. And so is enterprise value is equal equity plus debt minus cash. If company can be either the equity. Okay, so now we have value if you only look at the shareholders, or if you look at shareholders and debt holders, the whole value of the entire company is the enterprise value. Now, in order to do the multiples, so at the top, at the numerators of the multiples, I apologize, I really think that the concept map is switched off, but as an error here, but the at the numerator of your multiples, there will always be either the enterprise value or the equity value. Now, what do we have at the denominator? Enterprise value divided by what? Equity value divided by what? Well, usually it can be one of these 5 items. Okay? Again, this is a bit of terminology. This terminology is very American. I honestly, since I got my PhD in Europe, I'm not super strong on Aussie accounting terminology, so I don't know if you use these terms or slightly different terms. Normally, you see these in the international databases, so they should be known to everybody, but just in case. So, a valuation multiple is always a value of the company, equity value, enterprise value, divided by a number that measures how much creation of value there is, how much production there is of profits and stuff. And usually, you can go at different levels. Now, the most basic idea would be, let's use the net income. Let's use the net income. Earnings, profits. You can call it whatever you want. And that is, in fact, the most basic valuation multiple. The most basic valuation multiple is equity value divided by net income. Or if you want it on a per share basis, price divided by earning per share. Same thing. So this is the most basic thing. But imagine to apply this multiple to Amazon 3 years ago. Amazon 3 years ago had 0 net income. Actually, negative net income. Quite substantially negative. But the company was worth hundreds of billions of dollars. Okay? So how is it possible that a company that provides no net income has valued hundreds of millions of dollars? And I repeat, I apologize, maybe I should get it back, but I used to use a story of the week that was a 2012 journalist trying to make sense of the valuation of Amazon, and just couldn't make any sense. And he said Amazon will default in 6 months. Okay? Where it says, as this gigantic price, gigantic equity value, but negative income. Okay? So what's the problem of using income as a measure of value production of the company? That the company can be in a phase where you have to do, for example, a lot of investment, a lot of stuff. And so these are things that will, for now, create a negative income, but that doesn't mean that the company in the future will have a negative income. As soon as we are finished doing the investments, we will start getting the profits. Okay? So sometimes we don't want the net income. We want to look a little bit above. Here, the sequence is basically what you see in an income statement. Sales are on the top, net income is at the bottom. Sales is called, in finance speak, a top line number. Net income is called your bottom line. Okay? That's because they were put. Okay. So, one step above the net income, there is the EBIT, earning before interest and taxes. That is basically the operating income. Because basically it's your net income before you pay taxes and before you pay interest. Okay? Now, why I should use this in the valuation instead of the net income? Now, imagine that my target company has done some trick, some accounting trick, legal, so we pay 0 taxes, like many companies do, okay? Or some companies try to do. So my company has some, either because of legal structure or is incorporated in some weird island somewhere or whatever, pays very little taxes. If I look at comparable companies that are in a normal country, so they pay 30% of taxes, the net income is not a good valuation multiple, or any multiple based on the net income is not good, because their net income is much lower simply because they pay taxes. But I don't pay taxes, so I shouldn't be judged with the same multiple. Does it make sense? So the idea is, if my target company has a different tax regime or a different cost of debt, again, you can make the example, for some reason, my company has a very low cost of debt or a very high cost of debt, much different from the comparables, then net income is not a good measure. I need to use EBIT. And EBIT, really what it does is to give me a multiple based on the operating side of the business, not looking at the tax regime, not looking at the cost of debt. Okay? So that's it. Now, one step forward, step upward is the EBITDA or EBITDA. And the EBITDA is earning before interest, taxes, depreciation, and amortizations. Now, you will remember from your accounting that depreciation and amortization are nominal charges that you put in your income statement to account for the depreciation of your physical assets, for example, but they don't have a real cash outflow attached. And so it's usually considered like a measure of operating cash flows. Okay? You will see there is a whole school of thought in valuation that says earnings are bad, cash flows are good. The famous cash is king. Okay? And so there is this idea that a company can have a very weird depreciation and amortization regime, but it's just a way to not pay taxes or reallocate tax, so it's not really relevant. What really matters is cash flows. And so the idea is two companies that produce the same cash flows should have the same value regardless of whether one has less amortization or more depreciation, etc. So what really matters is not the earning but the cash. And so some people say, well, just let's look at EBITDA. And EBITDA is the most widely used valuation multiple. Enterprise value to EBITDA is the most widely used valuation multiple in corporate finance. Okay? Exactly because there is this bias of thinking what really matters is cash. Okay. Now, the following two are a bit weird and less used, but they can be interesting in some contexts. The gross profit is sales minus cost of goods sold. Now, cost of goods sold basically is an accounting terms that has the direct production cost of a gadget. Okay? So if you look at the operating expenses of a company, let's say a company that produces shoes, okay? It's a shoemaking company. If you take the total operating costs, you can split them in two. One is the so-called COGS, or cost of goods sold. Those are the direct cost of production, like leather, the rubber for the sole, the laces, the employees doing the actual work, all the direct cost of production. And then, separated from that, you have sales and administration costs, or SGA, sales, general, and administration costs. And this is all marketing expenses, headquarter expenses, all this other stuff. Sales, general, administration costs, okay? And the idea is that sometimes you want to judge the companies based on the profitability of the core business, the production side, okay? And you don't want your valuation multiples to be affected by marketing expenses or administration expenses. Maybe because you don't really care about that, because you say, once we merge, I'm going to gut the company, get rid of all the administration people, blah, 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 so I don't really care about their costs, okay? Finally, sometimes you may want to judge the company based on sales, and so you want to use sales as a measure of value. Enterprise value to sales is also quite used, as you have seen in the initial example, okay? And for example, enterprise value to sales is what you would use to evaluate Amazon. As I repeat, you cannot really assess Amazon on comparables because there are no companies even remotely comparable to Amazon, or it's very, very difficult. But for companies that have profits close to zero but a lot of sales, sometimes use enterprise value to sales as a valuation multiple. Okay, so this is a reason why you may have different measures of, let's say, value. Okay, here you have other bits of terminology. Here is a bit of different things. Sometimes when you look for comparables, one thing that we said is that you want comparables, companies with similar profitability to your company. How do you measure profitability? Okay, so profitability, some of the terminology is gross margin, that is gross profit divided by sales, EBITDA to sales, EBIT to sales. These are not valuation multiples because there is no firm value there. There is no equity value or enterprise value. It's just a measure of profitability that you can use to see if the companies are really comparable. Measure, for example, in this way. Okay, we said similar size, similar profitability, net income margin. So this is what I said when I was saying that the book goes a bit down the rabbit hole. So try to go back to the big picture. We are just looking at some accounting terminology that we need to know, for example, to find whether a company is comparable. And then one other aspect that your book tends to do all the time is to look at historical growth. So to say whether a company is comparable to yours, they should have some similar sort of growth, historical growth rate. For example, historical growth rate of earning per share or growth rate of sales, etc. So your Excel spreadsheet from the book automatically give you, if you put the three historical record, 2009, 2010, 2011, it gives you automatically the historical growth of sales. But even FactSet, automatically for every company, there is always a table with the historical growth, 1 year, 3 years, 5 years, for sales, earnings, EBITDA, EBIT, and everything. So it's very easy to find the information. Okay, I don't need to tell you what is the return on equity. These are other measures of profitability that the book tends to give. Now, when it comes to credit profile, you also want your comparable to have some sort of similar capital structure. Now, this is pretty well down the line. Sometimes you just can't get similar capital structures and you don't care that much. But if you're interested in assessing is the capital structure similar, usually what you look at is leverage, that very weirdly the book calls debt to EBITDA or debt to total capitalization. I find that nobody calls debt to EBITDA leverage. It's more like the book is saying, look, leverage is one of these two. But back one slide. If you look at debt to total capitalization or debt to equity, that also very important, coverage ratio. Coverage ratio is crucial, will become crucial in the second part of the subject when we go to leverage buyout. So is a terminology that you need to know. Let me tell you how much debt you have. But that's usually not much of a problem. The problem is how much interest you need to pay. That it was really captures how in trouble, for example, your company is, etc. And so sometimes one number that is used a lot is interest coverage ratio, that is usually EBITDA to internet expenses. Remember that EBITDA is the cash flow, operating cash flow. And so you say, okay, my company has EBITDA of 10 and interest expense of $9 million. It means that I'm barely capable to pay off the interest. I don't have much left over. Okay? Instead, if your EBITDA is 10 and your interest expense is 2, you have a lot of room to maneuver. Again, it's just the terminology, okay? It's not super relevant for the valuation, but it's just for you to catch up with the basic financial terminology. Sometimes the book will explain that sometimes you want to use EBITDA minus capital expenditure, because capital expenditure is actually money that goes out the company. More rarely, EBIT divided by interest expense. Okay, credit profile ratings, we can skip it. Now, these are two technicalities. Now, what it follows now is a couple of technicalities that are very crucial to the procedure. Practical, especially now that we have FactSet, is not super important because FactSet already takes care of everything for us. But, again, in terms of terminology, absolutely relevant. Okay? Now, let's assume that we have a company, okay? An Australian company who has the financial statement every June. Sorry, is there a question? Can I help you? Okay. Let's take an Aussie company that has a financial statement every June and then releases a quarterly statement every 3 years, every 3 months. Okay? Now, technically, I will show you in a second, Aussie companies only release statements every 6 months, but in the American case, it's 3 months, so let's just follow the example as it is in the book. Okay? And let's assume that we are in December, and we are doing the valuation in December. All our calculations, sorry, made a mistake. We are in October 10, the month number 10. Okay? So let's assume that we are in October, and we are doing the valuation. Which financial statement should we use? I mean, the company has been releasing financial statement for 50 years, so we have a lot of historical information. When we do the valuation and we are in October, which financial statement should we use? Well, the last annual financial statement is the financial statement that ends in June 2016. Okay? We could use that. That's the last financial statement available. Now, theoretically, you want to use the most updated information that you have. Okay, that's a general rule. If you need to buy the company today, you want to base your valuation on the most recent information available. And if you look at the release schedule, the problem is that the financial statement in June 2016 is the last available annual financial statement, but is already a bit old because the company has released new information in September, the new quarterly statement. And so, what you really want to do is to calculate a synthetic financial statement that is called LTM, last 12 months. And it's a very technical process, incredibly boring. That's why FactSet does it for us. But basically means we take the financial statement. Let's take, for example, income statement sales. Okay? I want to know what are the sales of the company in the last 12 months, or the LTM sales. So what you do is you take the sales in the fiscal year 2015, so basically the sales of the financial statement. And these sales, they cover from the end of June of 2015 to the June of 2016. We throw away the sales of the first 3 months, the so-called prior stub, and we add the sales of the last 3 months that are already available because the company has released a quarterly report. Okay? So this is a trick to build the LTM income statement. It basically means the last 12, or every number, sales, EBIT, EBITDA, blah, 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 will be defined over the last 12 months using all the most available information. There is nothing more recent than that. Any question? I repeat, it's a bit counterintuitive. Thankfully, we will not have to do it, but we need to understand how it's done. Okay? So LTM financial data, that's a big step that has to be done. Okay, so here we have a numerical example. Let's assume that you're performing a valuation exercise at the end of March 2018, okay, for an Aussie company. And again, this second slide is a bit more specifically Aussie, so there is one statement every 6 months. So we want the sales for the last 12 months. What do we have? Well, we have these 3 pieces of information. We have the annual statement at June 2017. That's the last annual statement available. And the sales are $1,000. Then what do we have? We have a bit of more recent information because we also know the income statement between June and December, or July and December 2017, and where the sales are 500. And then we also know the sales from the first 6 months of the old financial period, so from July to June 2016. So what are the sales in the last 12 months? Well, what we do is to take the sales from the annual statement. Then we take away the sales from July 2016 to December 2016. This gives me 700, and by definition, these are the sales from January to June 2017. Then I add the sales from July to December 2017, and I get 1,200. These are the sales in the last 12 months. Last 12 months is from January to December 2017. I repeat, the problem is that there is no financial statement that has this number. We need to construct it. Okay? Anyway, when it comes to LTM, the only important thing to remember is we need, since all accounting, everything is usually based on 12 months, we need sales, income, EBIT, EBITDA, all the income statement over 12 months, but we want the last 12 months, so the most recent information. And sometimes we need to patch it together, combining different statements. Okay. Second technicality. Forget about the table for a second. Okay? There may be some items in our income statement that are non-recurring, that are extraordinary. So let's assume that last year the company had a one-off cost for something weird that will not repeat in the future. That number should not affect my valuation because it's not going to be repeated in the future. Okay? So usually the second technicality is that you should, as much as you can, try to adjust your income statement for non-recurring items or extraordinary items. Okay? In this example, it gives you two things. Says, first of all, in the cost of goods sold, there is $5 million of write-down of inventories. Write-down of inventories means I'm a shoemaker, and I find out that in my inventories, my storage room full of leather, some of the leather has been chewed by rats. Okay, so I need to write down, eliminate, throw away $5 million worth of leather. Okay, now since when I discover it, A, I fire somebody, B, I build an insulation, so this is not going to happen in the future. That $5 million is a cost that will hopefully not repeat, so it shouldn't affect my valuation, so I'm going to throw it away. So my real cost adjusted is only, cost of goods sold is only 620 millions because those 5 millions will not affect. Second, I did some downsizing of my sales force. So I fired some salespeople, to put it blunt, and I had to pay $10 million of severance packages, severance pay, etc. Again, that's extraordinary, non-recurrent, so it should not affect my situation. So what we should do, and what your Excel spreadsheet helps you to do, is just to eliminate those costs. And then, of course, the file will do all the calculations, because what's going to happen is that if your costs go down, your taxable income will go up, and your taxes will go up. So you need, there are other technical adjustments that follow on. Okay? But basically, you end up saying, look, my net income is really not 60, but 69. Please notice that I have eliminated costs by 15, but my net income goes only up 9 because I pay more taxes. Okay? And so my net income goes up, my earning per share goes up, etc. Okay, so this is just, so technical adjustment 1, I need to build the last 12 months income statement. Technical adjustment 2, I need to eliminate all the non-recurrent expenses or revenues or whatever is in the income statement is going to happen and is extraordinary in nature. Okay, so finally, once we have all the accounting stuff put down, we are going to calculate the valuation multiples. And a first possibility is to go equity-based. So we only look at the value of the equity divided by the profits or revenues or whatever created for equity holders. And so in this case is either share price divided by earning per share, or if you want equity value divided by net income, is exactly the same thing. The number is the same. It's just a different expression. Because the only difference here is that you multiply both the numerator and the denominator by the number of shares. Okay. Or we want to use enterprise value multiples, where basically we consider flows of value both to debt and equity holders. And so you have enterprise value to EBITDA, for example, enterprise value to EBIT. Your book also and your valuation models also use enterprise value to sales. Okay? This is a bit bizarre and is useful only for weird companies like startups, etc., that have sales but no income, so all these other multiples don't work very well. Okay? Good. So Again, these are two different types of valuation multiple. Equity-based, enterprise value-based. They are both useful. You need to calculate both. Okay, sorry. Enterprise value to sales was 0. Okay. We can apply the valuation model. Your book introduces the step 4 that, again, is not really super logically important. In fact, it's not in the concept map. But here, basically, it's just saying, so now, evaluation multiples. One thing that you should do is to, as we said, first of all, now that we first of all try to organize your comparables into groups based on some sort of factors, either similarity, similar size, less similar size, or more similar business model, less related business model. In the tutorial, we will use an example. We will find the value of Sydney Airport. And when you do Sydney Airport, very interestingly, you don't have a lot of comparables in Australia. And so what JP Morgan does, that's the example that we will use, is they divide the comparable by geographical area. Australasia, Southeast Asia, Europe, America. Okay? Okay, so you want to divide your comparables. Let me skip on this. Okay. At the end, as we said, you're going to come to a piece of paper like this, or an Excel spreadsheet like this, that tells you, for every multiple, the average multiple for your comparables. Okay? We've seen this before. So how do we do the valuation? Okay, so first of all, common practice, you never put on paper, as an investment banker, you never put on paper a number. I think that's a trick that investment bankers do to save their own chops. So you never put a number, you always put a range. Okay? So you tell your client, look, a reasonable range is between this number and this number. Usually, again, here there is a little bit of art. Okay? So in this case, we take a multiple, whatever it is, enterprise value to EBITDA. And then we have the lowest possible comparable is 5.5 times. The highest possible comparable is 8.5 times. Okay? The mean is 7. The median is slightly lower. And here, you need to come up with some idea to provide a reasonable range. And the way they do it is to take the group of the closest comparables and say, look, I have two closest comparables, or the closest comparable goes from 6.5 to 7.5. The mean is 7. That's my range. Okay? And so you're going to say the range here is from 6.5 enterprise value to EBITDA to 7.5 enterprise value to EBITDA, and the mean is 7. Again, you will see in your assignment there is no rule to choose the range. You need to find a rule that works for you given your example. But basically, you need to provide a meaningful range for the client. The range cannot be too narrow, because then it's not a range, it's a number. And it can't be too low, because then it's useless. You can't tell your client, look, you should pay something between $1 and $1 billion. Okay, that's for sure is correct, but doesn't make any sense. This range, 6.5 to 7.5. Okay? Okay, so here what you have is the proper valuation calculation. Okay? So please remember Now, actually, that is the enterprise value to EBITDA based not on the LTM, but the 2012 expected. So it's actually not the EBITDA of the last 12 months, it's the EBITDA that the economy or the analyst expect for the current fiscal year, like the current 2012. So it's an expectation. Doesn't matter. So 6.5 to 7.5. Then we look at, say, okay, what is our EBITDA? In this case, what is our EBITDA expected for 2012? It's $2,015 million. So if the valuation goes from 6.5 to 7.5 EBITDA, and my EBITDA is 2015, I can simply multiply. And I can say, okay, so 2015 times 6.5, and that will give me 1398. Then I multiply 2015 times 7.5, and that will give me 1613. Okay? So, given this multiple, the implied enterprise value is something between 1.4 and 1.6 billion dollars. Okay? So the multiple, the range goes from the multiple to the enterprise value. Is this first step clear? Yes or no? Okay. Now, of course, remember that the enterprise value is equity plus debt, but I'm not buying the debt. I'm only buying the equity. So I need to go from the enterprise value to the equity value. So I take the net debt. Net debt is debt minus cash. So this company has $500 million of debt. So that range 1.4 to 1.6 enterprise value, since the debt is $500 million, the implied equity value goes from 900 to 1.1 billion. Okay? So I know that the value of the whole equity capital of the company should be something between $898 million or $1.1 billion, in that range. Finally, since I know that there are 100 million shares fully diluted, that gives me a price per share of between $8.98 and $11.13. Okay? So this is how the valuation works. Does it make sense? So remember is, we take the multiple, we multiply the multiple for the relevant financial metrics. In this case, the multiple is enterprise value to EBITDA, so we multiply times the EBITDA of the company. If it was enterprise value divided by sales, we would multiply by the sales, etc. And we look at the price. As you can see here, it's already giving you a hint. You never use a single multiple. In this case, we are using 3. We have enterprise value to EBITDA on 3 different time scales. Last 12 months, predicted to 2012, predicted 2013. Or forward 2012, forward 2013. That's a technical terminology. And those give you a slightly different valuation range. Thankfully, they all overlap 95%, so basically that gives you some sort of range. The valuation, if you start from the enterprise value multiple, because you calculate the enterprise value range, you take away the debt, you calculate the equity value range, you divide it by the number of shares, you get the price range. This is if you are working with an equity-based multiple, it's much simpler. In this case, again, we have ranges in terms of price earning. So if I take the last 12 months is between 13 and 16. That's the valuation range. The company has, let's say LTM, the company has $70 million of net income. If the company has $70 million of net income and the comparables are trading between 13 and 16, that generates an implied equity value between 910 and $1.1 billion. Again, I divide by the fully diluted number of shares, and I get the target price range. Okay? So in this case, it's a bit simpler. There is no more net debt because we are using a multiple that is based only on equity and not on enterprise value. Okay. Finally, this is the other thing that you will start to hate. This is a graph that invariably happens in every valuation document. And funnily enough, is a graph that Excel cannot make. So you either make it in PowerPoint, literally with squares and circles, so you fake it, or if you Google it, you will find a very, very weird Excel macro that I'm sure has some Russian bot start mining cryptocurrency in your computer, but that basically takes Excel, fifth dan, and start doing all macros, etc., to take a graph, print a figure, rotate 90 degrees, etc., to get to this graph. But what it is, so it's not a real graph, it's just a painting, basically. But basically, it's the so-called football field analysis, where you put in different lines all the multiples that you care about. In this case, we have the 3 enterprise value to EBITDA, but you can have on top of those the price earning multiples, other stuff. And for each one of them, there is a horizontal bar that tells you the range. And hopefully, you want to give the visual clue that all the ranges kind of overlap, and that you can find sort of a reasonable midpoint, and that's where you're going to aim. Okay? So I repeat, it's called football field analysis. It's a technical name, it's used all the time. It's in every single presentation that you will find. It's very weird because Excel cannot make it, and so it's basically always a painting of some sort. Okay, this is the story. We are still not done, so I still have 6 minutes of your time. What are the pros? The pros is that it's based on market valuations of other companies, is quick and is convenient. Okay, and you can use up-to-date information. So basically, it's market-based and it's convenient, quick and convenient. Okay, these are the pros. What is the gigantic cons of this methodology? What is the gigantic cons? Is that basically, so first of all, you may not have the good comparables, but the biggest problem is the first. If you are in a market bubble and all your comparables are overvalued, you're going to pay too much for a company. Okay, so this is the biggest problem, is that you're assuming that the valuation of the comparables is correct. If you are in a stock bubble and all the comparables are overpriced, you're going to translate that overpricing to your own company, you're going to pay too much. Okay, so that's the biggest problem. Now, all the rest you can almost forget. So the biggest thing is, A, sometimes you don't have good comparables. But B, even if you have comparables, if the valuation of the comparables is wrong, you're going to get a wrong valuation. Okay, so that's the biggest thing. Now, finally, okay, I've already spoken about the comparable transactions. You can have a look at it. This is all stuff that I've already said at the beginning. Now, for this week, you had the story of the week. We only have 5 minutes left, but it's more than enough. Read through the articles. It's quite, I mean, they are very short. Okay, But just to give you an idea of an example of how these things is used, what you will find, sorry guys, what you will find is the following. There is one first article that basically says Kraft has launched an hostile takeover of Cadbury. Okay? This is November 7, 2009. And sorry guys, sorry, I need 3 minutes of your time. And the price was $9.8 billion. Sorry, billion pounds. Or 720 pence per stock. Okay? So $10 billion. The next day, Cadbury says, forget it. Okay? I think that the operative word is that the offers is derisory or derisory. I don't know how to pronounce that word. But basically, it's laughable. Okay? Probably that's Oxbridge English, but says is laughable. Okay? And so it says, forget it. So the acquisition is officially hostile because Kraft makes an offer. The CEO of Cadbury says, at this price, you can shove it up where you know we are never going to sell. The price is too low. Now, the third document that you have is very interesting. And, sorry, who is going to decide to sell or not to sell at the end? Who is the ultimate decision maker? Yes? No, Cadbury, but Cadbury who? Shareholders. Okay? So now the CEO of Cadbury, who doesn't want to sell, needs to convince the shareholders. And so I gave you the PDF of the document that was sent to all the shareholders. And it's like a bunch of pages, all fully colored and stuff. But if you go to the core, they say Kraft's offer represent 11.6 basically enterprise value to EBITDA. Basically it says they are offering 11.6 times EBITDA, 2009 EBITDA. And then they say this is too low because if you look at 5 other transactions in the last years of similar companies, so you have Perfetti, this is an Italian company by Van Meller, Hershey by Wrigley, Cadbury buying Adams, blah, blah, blah. They say, if you look at these ones, the average enterprise value to EBITDA was between 14.3 and 18.5. And so they say 11.6 is ridiculous. Can you see that? So this is comparable transactions. Of course, they want very high valuation multiples, so they don't use comparable companies. They use comparable transactions, so there is implied synergies and control premium. So they say, look, that's what you have. Okay, then you can read, basically get to those levels, but we can give you, instead of 11.6 times EBITDA, we are going to pay you 13 times EBITDA. And so that works. Okay? Okay, sorry for the run-up at the end. That's all for today. See you at the tutorials in 10 minutes in Building 5. The end of the story is that at the end, Cadbury has to increase the price, $11.6 billion, and that is a 13 multiple. Okay? So basically what they did is to say, look, we are not